All right, so this is going to be a run through of Rocky Mountain Chocolate Factory's most recently filed annual report. Right here, you can see a small amount of shares trading as of May 11th, 2020, 6,060,663 shares outstanding. Not that much. Now, they are the Delaware Corporation, of course. They are located in Colorado. They are an international franchisor, confectionery manufacturer, and retail operator founded in 1981, headquartered in Durango, Colorado, and they make chocolate candies and other confectionery products. They own U-Swirl International, and they franchise and operate self-serve frozen yogurt cafes through U-Swirl. Their revenues and profitability derived principally from their franchised / licensed system of retail stores that feature chocolate, frozen yogurt, and other confectionery products. They also sell their candy in selected locations outside of their system of retail stores and license the use of their brand with certain consumer products. They also recently entered into a strategic alliance with Edible Arrangements and their affiliates to sell their candy in their store locations and through their e-commerce platform. They own an incredible amount of stores, 2 company-owned, 98 licensee-owned, and 237 franchised Rocky Mountain stores in 37 states and some different countries. U-Swirl is operated with 3 company-owned cafes, 59 franchised cafes, 25 licensed locations in 25 states, and Qatar, just the one random country out of all of that. U-Swirl operates self-serve frozen yogurt cafes under the names U-Swirl, Yogurtini, Cherry Berry, Yogli Mogli. I don't know who comes up with these names. Fuzzy Peach, Let's Yo, and Aspen Leaf Yogurt. 51% of the products sold at Rocky Mountain were prepared on premises. They pride themselves on the freshness of their products and the immediacy of being able to create those products as well. They entered into, right over here on page 3, they entered into their strategic alliance with Edible Arrangements. And they're just explaining a little bit of the nature of that, as well as through selling through Edible's website and through over 1,000 franchise Edible locations nationwide. U-Swirl cafes, moving down page 3, and their associated brands are designed to be attractive to customers by offering the following: inside cafe-style seating for 50 people, spacious surroundings of approximately 1,800 to 3,000 square feet, a variety of things that the customers can choose from as well when they go in the store for purchasing those products. Their revenues primarily came from sales to franchisees, which accounted for 68% of their revenue. Sales at company-owned stores of chocolates, candies, and frozen yogurt. 10% of their revenue came from that, and the collection of franchise royalties and marketing fees were 22% of their revenues. 99% came from domestic sources. So the international segment is still very, very small and not really bringing a whole lot. Obviously, page 4, they're talking about COVID-19. This is a retail location, so retail has been hit very, very hard by the closures. This is going to play in a little bit more later on in the annual report. Now, here they break down some of their same-store sales segments for Rocky Mountain and U-Swirl. For Rocky Mountain, the store growth, same-store sales has not grown much for Rocky Mountain Chocolate Factory. It's tended to be very small. For U-Swirl, there's been almost none, almost no same-store sales growth, and COVID has completely wiped out all same-store sales growth for Rocky Mountain Chocolate Factory and U-Swirl as well. So these numbers are probably going to be completely irrelevant after. These numbers are going to be completely tarnished when COVID-19 is all said and done. Same store pounds purchased by existing franchise and licensed locations. Moving down page 5, same store pounds purchased by franchisees and licensees decreased 4.6% compared to last year. And that drop is apparently due in part to a product mix shift from factory-made products to products made in store, such as caramel apples. Moving on down, they continue to pursue unit growth opportunities, especially as a result of the COVID-19 pandemic. They've been trying to look for growth in locations where they have traditionally been successful. But as we saw on page 5 here, growth has not really been their strongest suit for Rocky Mountain, let alone U-Swirl. U-Swirl has been growing negatively for same-store sales. They're sitting on a 56 Rocky Mountain locations in Canada, 1 in Panama, and 1 in South Korea, 3 in the Philippines, and apparently here 2 international units in Qatar. They produce 500 chocolate candies, primarily making a lot of their sales for holidays, Christmas, Easter, Valentine's Day, holiday season, where they make up to 100 items, including many stuff offered in packages. A typical Rocky Mountain store offers up to 100 of these approximately 500 chocolate candies and other confectionery products throughout the year, and an extra 100 during holiday seasons. Chocolate candies, and they break down some of their pricing here. They're typically sold between $20 to $29.99 per pound, average price of $24.11 per pound. Franchisees set their own prices, but they do offer recommended pricing for all their products. The frozen yogurt cafes, they break down some pricing information over here too. Cafes typically sell frozen yogurt by the ounce, with prices ranging from 46 cents and 61 cents per ounce. In their operating environment, again, COVID-19 has really hit this company hard because they're located in regional centers, outlet centers, community centers, tourist areas, airports, street fronts, and other locations. And all of these areas have been hit hard, meaning shut down completely by COVID-19. These are places with high foot traffic. And right here they mention their regional centers are the largest ones, including a Mall of America. They have a big location there in Minnesota. High levels of foot traffic, but it's very expensive rent, and they have to compete with other food and beverage concepts. Outlet centers, 39. They have 39 Rocky Mountain locations and outlet centers. Although not all factory outlet centers provide desirable locations for their stores, they do mention their relationship with the developers to be seen as an advantage. Tourist areas, airports, other entertainment-oriented shopping centers. They have 28 Rocky Mountain Chocolate Factory locations in tourist areas, street fronts, airports, and other entertainment-oriented shopping centers. As of February 29th, 2020, 11 franchised Rocky Mountain Chocolate Factory stores are at airport locations. And for the strip and convenience centers, self-serve frozen yogurt locations are primarily located in strip and convenience center locations. Such places like these generally offer favorable rents and the ability to operate during hours when other operating environments are closed, such as late at night. So they have some flexibility with how all these stores are laid out. But once again, it is July 2020, and we're staring down the second barrel of closure. So I want to keep everything within current present day light of how they're going to try to work through COVID-19. And the look of it is that this company is somewhat in danger. Now, moving on down, they kind of explain some of their franchising and licensing concepts overseas here. Licensing arrangements for the countries: South Korea, Philippines, Panama, Vietnam. They did have one in Vietnam. They took that out. That's done. And they have an additional international development agreement covering Canada and Qatar through USwirl. There's no units operating USwirl in Canada, and there's 2 units for USwirl over in Qatar. Um, They, on page 9 here, they entered into a licensing agreement with Kahala Franchise Corp. Select current and future Cold Stone Creamery franchise stores are co-branded with Rocky Mountain Chocolate Factory and the Cold Stone brands. They have 98 stores under the co-branding agreement with Cold Stone. And they also allow USwirl brands to offer Rocky Mountain products under similar co-branding agreements. There's 10 franchise and company-owned USwirl cafes offering Rocky Mountain products. They do have a training center for their managers, their owner-operators, over in the Durango headquarters in Colorado. Talk about their quality standards a little bit. They typically don't offer financing for franchisees. Didn't mention something interesting here. They began an initiative to finance entrepreneurial graduates of the Missouri Western State University entrepreneurial program. So they are active players in their community, actively looking for fresh talent to hire on the company. They beginning in FY 2010, recent graduates were awarded the opportunity to own a franchise under favorable financing terms in 2010. As of February 29th, 2020, $158,000 was included in notes receivable as a result of this program. As of March 31st, 2020, there were 18 units in operation by graduates of this program. And they're going to continue working with other colleges, including Fort Lewis College and Durango, to develop similar programs to kind of seed talent from local colleges into their businesses. Here they talk about a little bit of their ingredients. So they are subject to commodity prices. They own their own trucking fleet. On page 11, they operate 9 trucks and ship a lot of their own products from the factory to their own fleet. Their trucking operations enable them to deliver products into the stores quickly and cost effectively. They also backhaul their own ingredients and supplies, as well as products from third parties on return trips, which helps them achieve even greater efficiencies and cost savings. All the chocolates are made at their Durango location. They tend to avoid national traditional media advertising on page 12. Consistent with their commitment to community support, they do their best to stay pretty active in the community through charitable causes and events and organizations such as Fudge for Troops and Care and Share Food Bank. And consistently try to create the family-friendly image of the local candy store being the place where all the heartwarming events happen. Now, they mention here on page 12 that they have gotten into licensing agreements with Kellogg. The most recent example of those licensing agreements being the announcement of Rocky Mountain Chocolate Factory breakfast cereal. I just got a cavity reading that out loud, so my mouth hurts. I am sorry. They do mention their competition. Immediately, I assume that they're competing with See's Candies, owned by Berkshire Hathaway. They believe their principal strengths lie in their reputation and recognition. Of course, they're going to say that. Of course, they're going to sell their book like that. A little bit of regulation, page 13, their employees. I do like to see this phrase. Once again, I want to see this when I read a 10K. They'd consider employee relations to be good. I want to see that the company outlines that immediately. You get to risk factors. COVID-19 has a full page dedicated to it. It's a big issue. It's a big problem. And they go down the list here. Page 17 is very important. June 2019, their largest customer, FTD companies, filed for Chapter 11 bankruptcy liquidation. And they had to write off a lot of provisions for inventory that they're not going to get back. So as a result of their bankruptcy, the court has actually decided to reject and not enforce the terms of the supplier agreement that Rocky Mountain signed with FTD companies. The gourmet food supplier agreement that provided assurance that custom inventory purchased by the company and developed specifically for FTD would be purchased upon termination of the supplier agreement. The court said they don't want to do that, so they're not going to follow and enforce it. The company is uncertain if accounts receivable and inventory balances associated with FTD will be realized, and the company recognized an estimated loss of $230,384 associated with inventory specific to FTD that they more than likely will not make any money back on. Revenue from FTD represented approximately 5% of their total revenues in 2020. For the year ended February 29th, 2020, compared to 9% of their total revenues during February 28th, 2019. This is a pretty big customer that they've lost, and that more than likely they won't be able to fill back rather quickly. This is a little bit of a hairy situation. Now, they do mention here on page 18, same-store sales have fluctuated and will continue to fluctuate. Same-store sales. And you want to look into this definition here, how they define that. You want to see if that changes over time. They define it as year-over-year sales for a store that has been open at least 1 year. You want to keep in mind if they do start shifting around how they define same-store sales, they might be playing games. But I want to keep in mind that they did say here at least for 1 year. Now, if they change that from here on, that's a problem. But I want them to say to themselves they define same-store sales for at least 1 year. During the past 5 fiscal years, same-store sales have fluctuated. For Rocky Mountain as follows, as we discussed earlier, it's been pretty low. And it's going to get lower. They own all of U-Swirl, which has a history of losses. On page 19, they obtained U-Swirl in February 2016. They bought all of the outstanding common stock of U-Swirl. If they are not profitable in the future, then the company has an even larger problem. Now, in January 2013, they initially bought their first stake in U-Swirl, and we saw above that the same-store sales for U-Swirl have been decreasing, which will seem to only get worse. This is a little bleak for them, but they may be able to pull something out. They mentioned here on page 21 going into page 22 that they see a higher minimum wage as a problem for the business. The federal minimum wage being $7.25 for the past 11 years. Where they mention here that Colorado has set the minimum wage at $12 an hour. We may be unable to increase our prices in order to pass future increased labor costs onto our customers, in which case our margins would be negatively affected. Now, they also mention here on page 23, I'm going to move on down. For properties, for the manufacturing properties, the corporate headquarters at 53,000 square feet manufacturing facility that they own outright, and they produce in their corporate headquarters 1.93 million pounds of chocolate candies, which is a drop of 11.9% from approximately 2.19 million pounds of candies produced in 2019. The principal offices for U-Swirl are located in the same places. As of February 29th, 2020, they have obligations for 2 non-cancelable leases of 5 to 10 years for Rocky Mountain, with varying expiration dates from July 2021 to January 2026. And you move to page 24, and they actually mentioned some of their lease payments. They currently have 2 cafe leases in place, which range from $6,600 and $8,400 a month, exclusive of common area maintenance charge and taxes. I've never seen a company actually list out their rent costs monthly before, so that's pretty new. I've never seen that before. 400 record holders of their common stock since May 11th, 2020. They did suspend the dividend. I don't know why they're paying a dividend. They were paying one at all, quite honestly. The company doesn't really need to do that, in my opinion. But they have decided to suspend the dividend to save cash because COVID has been nightmarish. They did get a paycheck protection loan from the Triple P program. They mention this here on page 27, and it has allowed them to temporarily avoid workforce reduction amidst a steep decline in revenue and production volume. And they are mentioning on page 28 that they are taking a conservative view of market conditions going forward for fiscal year 2021. And they're going to sit very heavily on their strategic alliance with Edible Arrangements to try to weather this storm out. EPS dropped 55.3% from 38 cents last year to 17 cents for fiscal year 2020. 38 cents per share in FY 2019 to 17 cents in FY 2020. Operating income decreased 53.7%. And the reasons for it are on page 29, associated with the company's previously announced revenue of strategic alternatives, which formally concluded with the company entering into their strategic alliance with Edible, costs associated with the stockholders' contested solicitation of proxies, and costs associated with the bankruptcy of FTD companies. You can see just how much of a drag that bankruptcy was and is on their sales. Factory sales tanked because of it. Decrease in factory sales was primarily due to a 40.2% decrease in shipment of products to customers outside their network of franchise and licensed retail locations. The decrease in retail sales was primarily due to changes in retail units in operation resulting from the closure of certain underperforming company-owned locations. Same-store sales at all company-owned stores actually increased 1.6% during FY 2020 compared with FY 2019. Here, their breakdown of cost of sales and expenses. They do mention for the change in SG&A, 67.1% increase. It was to kind of get a shareholder off their back that was kind of bothering them. So it's a one-time increase, a one-time bloat, if you will. Now, let's see what else is really important to cover. Page 32, they're talking about a little bit about their liquidity and capital resources situation. They mentioned cash has a decrease from 5.4 million to 4.8 million. The current ratio is 2.4 to 1 at February 29th, 2020, compared to 3.0 to 1.0, 3 to 1 at February 28th, 2019. So the company is kind of crunching into itself a little bit here, and that is a bit of a problem. They mentioned here that they have a credit line for general corporate and working capital purposes. And that credit line is secured through the borrowing base of 50% of eligible accounts receivables plus 50% of eligible inventories. And it can be renewed September 2021. And they drew down the maximum amount available, an amount equal to $3.4 million. They mentioned here the PPP loan. They got through First Source Bank through the CARES Act. They received $1.5 million, and it matures, I should say, April 14th and April 20th, 2022, with a 1% interest rate. And some of the contingencies here. That at least 75% of the loan amount is used for eligible payroll costs, the employer maintaining or rehiring employees and maintaining salaries at certain level in accordance with the requirement of the CARES Act and the PPP. The company intends to use the proceeds from the SBA loans primarily for payroll costs. Pretty textbook stuff, I think. They do mention off-balance sheet arrangements of approximately $274,000. They are contractual obligations to buy the commodities used to make their products. The provision, and on page 34, they talk about the provision for uncollectible accounts, receivables. Over the past 3 years, their allowances for doubtful notes and accounts have ranged from 10% to 13.6% of gross receivables. Honestly, this seems pretty large. I don't know what's going on, but it can't be good that the allowance for doubtful notes and accounts have ranged from 10 to 13.6% of gross accounts receivable. So they might have some trouble collecting from their customers. Revenue recognition here, they mentioned ASC 606, of course, pretty typical stuff. They recognize a marketing and promotion fee of 1% of the Rocky Mountain and US World stores' gross retail sales and a royalty fee based on gross retail sales. They recognize no royalty on franchise stores' retail sales of products purchased from the company. It recognizes a 10% royalty on all sales of products sold at franchise locations. Royalty fees for US World cafes are based on the rate defined in the acquired contracts for the franchise rights and range from 2.5% to 6% of gross retail sales. Inventories. The company recorded an expense of $312,200, averaging that amount per year for potential inventory losses, or approximately 1.6% of total cost of sales for that period. Franchise rights are considered to last for at least 20 years. They do not include, on page 35, quantitative and qualitative disclosures about market risk. Plant & Moran is their auditor since 2004. Apparently, they clear the audit in all material respects. I am looking for this phrase. I found in another company that I'll cover in another video that they don't cover. The auditor did not put that phrase in. So it is something I try to look out for at the very, very least. Plant & Moran is their auditor up here, and they began to serve the company's auditor in 2004. In 2019, they became the predecessor auditor, EKS&H, over here on page 38. So I guess they have two auditors, or they did. I do not know. I admit I do not understand a lot of this, but I'm learning. Now, another thing I'll look for on page 44, I will look how they write down the depreciation for property, plant, and equipment. It is simple, computer using the straight line method. Here they still break down accounts and notes receivables even more. As of February 29th, 2020, the company had $450,215 of notes receivable outstanding and an allowance for doubtful accounts of $0 associated with these notes, compared to that much, $391,000 odd. An allowance for doubtful accounts of $0 as of February 28th, 2019. And the notes require monthly payments and bear interest rates ranging from 4.5% to 6%. For for notes receivables. I'm going to scroll right down here. Page 46, again, they talk about the bankruptcy of FTD. They're going to have to keep reeling from this one. And they mention on page 47 how much they paid for advertising expenses. I haven't really seen a whole lot of this either. They actually somewhat dropped a lot of their advertising expenses for Rocky Mountain over the past 3 years, with 2019 being the lowest year, $275,441 spent in 2019 and $276,602 spent for 2020. The ad expenses for USwirl also relatively small, $203,000 for 2020 USwirl ad expenses compared to $168,000 spent in 2019. 47, they mentioned their related party transactions. They entered into the long-term strategic alliance with Edible. Also in fiscal year 2020, the founder of Edible was elected to the company's board of directors pursuant to a vote by stockholders at the meeting of stockholders. As of February 29th, 2020, the company recognized approximately $320,000 of revenue and AR related to purchases from Edible, its affiliates, and franchisees. Here they break down the annual revenue expected to be recognized in the future from initial franchise fees, license fees, transfer fees, and renewal fees. They break down revenue here on page 48 and 49. Factory sales, manufacturing is the largest chunk of their revenue at $21.5 million. Retail sales, primarily from USwirl, are actually the largest over here. And franchising for royalty and marketing fees is the largest chunk for Rocky Mountain stores. For inventories, the vast majority of inventories are held in ingredients and supplies. And also, they're sitting on $10.6 million of machinery and equipment, which I found actually rather interesting. Was not expecting that much. On page 50, they talk about their line of credit. $5 million working capital line of credit from Wells Fargo. Draws made are under the line at 50% of eligible accounts receivables plus 50% of eligible inventories, borrowing on LIBOR plus 2.25. The credit line is subject to renewal in September 2021. This actually changed on page 50. This actually changed in the most recently filed 10Q. It's not a good change, to be quite honest. In some instances, on page 51, they talk about their leasing arrangements. The company has leased space for its company-owned locations that are now occupied by franchisees. When the company-owned location was sold or transferred, the store was subleased to the franchisee who was responsible for the monthly rent and obligations under the lease. I found that one pretty fascinating, that they are subleasing locations. Weighted average lease term is 6.7 years. On page 52, it is mentioned there. For another breakdown for the balances associated with losing FTD as a customer, they lost $335,000 odd for ingredients and supplies. Most of it wasn't even finished. Accounts receivables were $79.7 thousand. and a total potential loss of $232,856. On page 54, they also mentioned that they gave warrants in consideration of Edible entering into the supplier agreement. They gave warrants to purchase up to 960,677 shares of the company's common stock at an exercise price of $8.76 a share. The warrant expires 6 months after the final and conclusive determination of revenue thresholds for the 5th contract year and the cumulative revenue determination in accordance with the terms of the warrant. There's a little bit of a breakdown for their deferred tax assets and liabilities. So they break down their operating segments here for FY 2020. They break down segment CapEx and segment D&A. And honestly, I like that. I like that they can break it open for us and see what they're actually making. I'm going to go down here for the credit draw. They mentioned that they draw down on all of it. On page 59, the outstanding principal balance under the line of credit will be due and payable in full on September 30th, 2021. The interest rate on March 16th, 2020 under the line of credit was 3.06%, which represents the 1-month LIBOR rate plus 2.25%. Excuse me. So I'm going to skip over the 10Q and skip over to what I really want to bring up. On page 24 of their most recently filed 10Q, you have a section here for the revolving credit line. The company has a $5 million credit line for general corporate and working capital purposes. They drew down the maximum amount on March 16th, 2020, an amount equal to $3.4 million, as we just covered. Additionally, the line of credit is subject to various financial ratio and leverage covenants, and pay attention very carefully. As a result of COVID, the company failed to meet the amount of EBITDA required by this covenant. On June 26, 2020, Wells Fargo delivered the company a reservation of rights letter, the bank letter, and that reserved all rights available to Wells Fargo under the credit agreement to demand immediate payment of all amounts outstanding under the credit agreement. They are not compliant. This is very important. Not compliant with a covenant line, a covenant of the line of credit that requires the company to have 1.5 million of adjusted EBITDA. So the company intends to work with Wells Fargo to amend the associated covenants as the trend related to COVID-19 continues. The credit line is subject to renewal September 2021, but they also mentioned that there is no assurance that Wells Fargo will agree to any proposed amendment. And right now, I can't imagine that Wells Fargo will agree to anything less than what they are entitled to. The bank is not exactly in the easiest time currently. So this is going to be a pretty hairy situation for them to get out of, quite honestly. But as of right now, they are not in compliance with the terms of their revolving credit line, and that is a big, big issue. Now, I moved on to the valuation part here. And one of the basic questions I'm going to ask for any company is, are they meeting their weighted average cost of capital? That's all I want to know. Do they have a return on invested capital greater than their weighted average cost of capital? And I'll put this spreadsheet up. I'll put a link up in the description box for those that want to sit there and kind of thumb through how I did this and see if you agree with some of the ways I calculated it out. I came up to an answer of that they have a cost of debt, after-tax cost of debt of 1%, a pre-tax cost of debt of 1.27%. The average sector beta was the amalgamation of finding other competitor companies in their segment of the industry. Same thing, taking the average sector debt to equity ratio. I got a levered beta of 0.067 for the company. The cost of equity of 5.933% with a weighted average cost of capital of 5.256%. So right here, right out the gate, yes, they do create value, but the company is in a bit of a hairy situation because of COVID-19. Now, once again, I want to point out that in this video, this is not investment advice. You are to do your own reading and do your own due diligence. But right now, and I want to see how this plays out, because this is a pretty dangerous situation that they're in with a bank that's going to want to come back to get their money, to get their money's worth from the company. So part of the problem is that the company now has restrictions on their ability to draw funds any further from the line of credit. So the tap water has been shut off for the company, and this is going to be a bit of a problem for them to get out. Other than that, do I think that they can draw down? Do I think Wells Fargo can get their money back from 50% of eligible accounts receivables plus 50% of eligible inventories? More than likely, yes. So half of 2.3 million, and then another half of 4.14 million. Yes, I think they can get their money back, and the company will be just fine. But I think this does not bode well with managerial leadership here, that the company got into this situation in the first place. I'll leave this. I'll leave this up in the comment section to show you guys how I calculated this out. Thank you.